Hello and welcome to Inside ETFs. I'm Ramzan Karamali. Today we're looking at actively managed ETFs and my guest is Matt Bartolini, State Street Global Advisors Head of ETF Research. Since a 2019 rule change by the Securities and Exchange Commission, which streamlined the process for launching new ETFs, there's been a significant rise in the number of actively managed funds. In fact, they've enjoyed record flows this year. Though they tend to carry lower fees than their mutual fund peers, their fees are higher in general than most passively managed funds. And despite the interest in them, not all of them outperform passively managed index funds. The biggest is the JP Morgan Equity Premium Income ETF, JEPI. It's up on the year, but its return this year to date is less than half of the biggest ETF out there, Spider's SPY, which tracks the S&P 500. So as demand for actively managed ETFs continue to rise, are they actually worth it? Well, to help answer that and more, I'm joined by State Street Global Advisors Matt Bartolini. Matt, thanks so much for joining us. So over the past 5 years, there's been a massive rise in the interest in actively managed ETFs. Is this all down to those rule changes by the SEC, or is there more to it than just that?
So I think the rule change in 2019 definitely helped. So that's 6C11 for those that are following the SEC rules. But there was also another one, 18F4, that then came later that talked about the derivatives rule and the ability to use derivatives within associated ETFs and how that could actually impact your leverage. So these regulatory rule changes have actually accelerated some of the more novel approaches that ETF issuers can bring to the marketplace, and they're bringing those within an active construct. So I think part of that is the reason, those regulatory backdrops, but more firms are now coming into the active ETF marketplace because of these relaxed constraints. And then also just the ETFs that were sitting out there for some time have now built identifiable track records from a performance perspective, but also identifiable track records from a trading and liquidity perspective, as we saw them be able to navigate the effects of 2020 and so on and so forth. So I think there's been a lot of comfort associated with the ETF structure, and there's been more choice, which has really been a benefit to the overall flows and asset levels.
Now, what about performance, Matt? If you're paying higher fees for an actively managed fund, how do you ensure that you get better returns than, say, on a passively managed fund?
Well, I think sometimes within the active constructs, I think when we're looking at it, it's not just about alpha. So if we break out the active ETF marketplace, you have alpha generating strategies that are seeking to outperform a stated benchmark, and then you have outcome oriented strategies. So defined outcome, buffered ETFs, maybe derivative income ETFs that are focused on providing a specific outcome and are doing it actively because they can utilize the flexibility of the ETF structure, and you can do that better under an active exemptive relief. So sometimes it's not so much about generating the alpha, it's more about providing that outcome as well. And the fees that you're able to charge for that should be reflective of your ability to provide either A, that alpha, or B, that unique outcome.
Now, actively managed ETFs, do you think they can be used in a sort of buy and hold strategy as well?
Well, I think they definitely can, but not all of them. So some of the active ETFs, they perhaps would not be part of your core buy and hold, and then some others could. So if we take fixed income, for example, the fixed income markets are largely inefficient. And if markets are inefficient, you can use active managers to seek to exploit those inefficiencies and generate a potentially above market returns over a full market cycle. So your intermediate core and core plus funds, I think those are definitely something that you'd want to consider for long-term buy and hold allocations in the largest part of your portfolio within the core. But also then some of them perhaps could be used more tactically. So we see senior loan ETFs, they're actively managed. In a period of, say, rising rates, we saw significant flows go into active senior loan ETFs as a result of the demand for that coupon that continued to rise. Similarly, on the other side, within the equity space, you have some defined outcome funds that seek to limit volatility. Well, if you think you're going to interact significant macro volatility and market sell-offs, perhaps those funds could be utilized to mitigate downside risk more appropriately or more specifically relative to, say, low volatility equity strategies. So I think there's a case for both. You just can't say all of them are buy and hold. There are some that are buy and hold, and then there are some are really exposure vehicles and maybe based on the right marketplace could be the correct tools for action.
Now, it looks like we're on track to hit $1 trillion in active ETF assets this year. And how significant is that?
Well, I think it's quite significant. I mean, it shows the maturity of the industry. I mean, right now you have active ETFs that only make up roughly about 8% of all overall ETF assets, but they're taking in roughly 30% of the flows. So they're becoming a more and more larger player in the ETF marketplace. It shows their growth, their maturity, and a pretty strong milestone, just given the fact that just a handful of years ago, we're only roughly around 400 billion in assets. So significant growth. And it boils down to those three C's that I sort of mentioned, two of at the top. You have more choice, there's more comfort, and then there's also just that lower cost. So relative to the actively managed mutual funds, they are lower cost. So those three C's can be beneficial to the long-term growth of active ETFs.
Matt Bartolini from State Street Global Advisors, many thanks for your thoughts. And that was your look at actively managed ETFs. I'm Ramzan Karmali, and this is Reuters.